I have been around markets long enough to know that the moment they start feeling the most unbelievable is usually the moment people begin confusing price movement with clarity. That is where we are now. You look around and see stocks ripping higher, risk assets acting fearless, people talking as though the next phase of prosperity has already been approved. And yet underneath all of that, you can still feel something grinding in the machinery. The economy is not clean, inflation is not dead, energy is not calm, and the Federal Reserve is not handing out easy money the way many people hoped it would. That combination is exactly what makes this moment so dangerous and so fascinating. Because when markets rise aggressively in the face of unresolved problems, people start using the rally itself as proof that the problems no longer matter. I do not think that way. I think the rally is telling you something, yes, but not necessarily what most people want to hear. It may be telling you that liquidity, positioning, and future expectations are overpowering current pain for a while. It may be telling you that Wall Street is betting on a different tomorrow than the one Main Street is still living through today. It may even be telling you that we are entering the kind of final euphoric stretch where asset prices keep floating upward precisely because people are becoming numb to the contradictions. That is the melt-up dynamic. Not optimism because the world is clean, optimism because the market decides it can step over the dirt for one more stretch. Now, if you want to understand why the Federal Reserve is not cutting rates the way so many people expected, you have to begin with the thing that still sits behind almost every price in the modern economy. Oil people love to talk about inflation as if it is an abstract policy concept. It is not abstract. It moves through freight, plastics, agriculture, transport, manufacturing, packaging, utilities, and almost every other process that delivers finished life into your hands. When oil rises hard enough, it does not stay politely contained in the energy sector. It leaks into everything. That is why I pay attention when energy moves violently. The IAEA's own work shows Brent moving from an average of $81 in the first quarter of 2026 to a forecast peak of $115 in the second quarter. With futures having already surged dramatically by the end of Q1, that is not a side note. That is an inflation problem with shoes on. Phasite, Phaeturn 625,523, search 1, Phaeturn 625,523, search 4, Phaeturn 625,523, search 13, Phay, and the Federal Reserve knows it. At the 29th of April 2026 meeting, the committee kept the target range for the federal funds rate at 3.5% to 3.75%, and Powell said directly that higher energy prices will push up overall inflation in the near term. Phasite, Phaeturn 990,104, search 2, Phaeturn 990,104, search 4, Phaeturn 625,523, search 15, Phay. That is the first reality people need to accept. The Fed did not suddenly freeze because it enjoys being difficult. It froze because inflation pressure has not fully left the room, and energy is one of the clearest reasons why. Now here is where things get strange. At the same time that inflation concerns remain alive, stocks have been rallying like they can smell a future that does not yet exist in the data. That kind of behavior always makes people uncomfortable because it creates a split-screen economy. On one screen, the market says tomorrow is improving. On the other screen, ordinary people still feel the cost of today. Consumer sentiment can stay weak while stocks move higher because they are not measuring the same thing. The market is not asking how people feel buying groceries this week. It is asking what earnings, growth, and policy conditions might look like many months from now. Those are different questions, and they often produce very different emotional outcomes. That is why periods like this feel so morally offensive to people. Asset owners appear to get richer while everyone else is still living with the immediate sting of prices, rates, and uncertainty. But the market was never built to reflect emotional fairness. It was built to discount future cash flows. That is what makes it so uncomfortable and so useful at the same time. Now, let me be clear about something else. I do not take this rally as proof that everything is healthy. I take it as proof that markets can outrun common sense for longer than most people imagine. That is why trying to time them with confidence is such a losing habit. People sold in fear a few weeks ago because they wanted clarity, and then clarity arrived in the worst possible form after prices had already moved higher. That is almost always how this works. The market looks most dangerous when it is often offering the best long-term prices, and it looks most reassuring right before it reminds you that reassurance was the expensive mistake. This is one reason I have so little interest in pretending I can perfectly map the next 6 months. I do not know what oil will do next. I do not know what one political headline will do next. I do not know whether inflation softens faster than expected or reaccelerates. I do not know whether the rally extends, stalls, or snaps. And neither does the person on television who speaks with the most conviction. What I do know is that the discipline of steady investing survives uncertainty much better than the ego of prediction. That is why I keep returning to the same conclusion. You decide how much to invest. You decide what mix you can emotionally survive through a real drawdown, and then you keep going. Now, before I come back to that, let me walk through the other parts of this puzzle because they matter too. Bitcoin is part of the story because whenever people begin doubting the long-term purchasing power of sovereign money or the stability of traditional policy discipline, hard asset and alternative money narratives tend to get stronger. And that is exactly what happens when a rising national debt, unstable energy prices, and a cautious Fed all share the same stage. People start looking for something outside the normal frame that does not make Bitcoin safe, it does not make it stable, it does not mean everyone should own it. What it means is that the same environment that makes people uncomfortable with cash and impatient with bond, like outcomes, also pushes them toward assets that feel less tied to the ordinary monetary machine. That is why Bitcoin can rally alongside a strong stock market in a period like this. It becomes part risk asset, part distrust asset, part hedge against policy slippage, and part pure momentum expression. That is a strange mix, but markets often reward strange mixes before they punish them. Housing is another area where people are misreading what is happening because they keep trying to reduce it to a single national answer. There is no single national answer. There are overheated regions where prices outran local affordability and are now softening. There are constrained regions where the supply picture still supports prices. There are markets where sellers are adjusting faster than buyers expected, and others where the opposite is true. What ties all of them together is mortgage rates. Housing is not just a shelter market anymore. It is a rate market wearing a suburban costume. And when energy pressure feeds inflation expectations, mortgage rates tend to stay sticky enough to suppress affordability. That does not mean housing crashes everywhere. It does mean relief is slower and weaker than many people keep hoping for. That is why I do not laugh when people say housing feels frozen. In many places it is. Not frozen in a zero transaction sense. Frozen in a psychological sense. Buyers are waiting, sellers are negotiating, the urgency is lower, and the market is no longer behaving like the one-way machine people got used to during the easiest money years. Now let us come back to the Fed, because this is where the narrative gets especially messy. A lot of people want a simple leadership story, Powell out, Warsh in, different person, different outcome, problem solved. I do not think it works that way. Yes, Kevin Warsh has been nominated to chair the Fed. That is real. The White House announced the nomination in January, and his confirmation process has moved forward. Faysite Fayturn 990,104 search. 6 Fayturn 990,104 search. 9 Fayturn 990,104 search. 5 Fay, but official Federal Reserve sources still show Jerome Powell as chair, and the 29th of April. 2026 FOMC Street 8 lists Powell as chairing the meeting and voting in that role. Faysite Fayturn 990,104 search. 1 Fayturn 990,104 search. 2 Fayturn 990,104 search. 3 Fay. That matters because people keep building investment narratives on top of dates and assumptions they do not actually have official confirmation for. I am not interested in that sort of fragility. The deeper issue is not one man. The deeper issue is that the next Fed leadership phase, whoever steers it, will inherit the same ugly set of tensions, inflation pressure that can reappear quickly through energy, a market that wants easier money, a government that prefers lower borrowing costs, an economy still vulnerable to slowdown, and a financial system that keeps trying to levitate whenever people believe the bill can be pushed one quarter further into the future. That is the real setup. If you reduce it to one personality, you are making the problem too small. So what does all of this mean for someone trying to survive the next year without becoming either reckless or paralyzed? First, stop trying to turn every macro headline into a heroic timing decision. If you sold because you wanted certainty, the market likely punished you already. If you are waiting for things to look safe, you may wait until the safe feeling itself becomes the overpriced part of the cycle. Second, understand that markets and sentiment can diverge for longer than seems emotionally reasonable. Wall Street can celebrate tomorrow while households still suffer. Today, you do not have to like that. You do have to recognize it. Third, do not confuse melt-up conditions with permanent prosperity. Asset inflation can feel intoxicating right before the costs show up somewhere else. The last phase of a cycle often feels best if you look only at prices and not at the stress building underneath them. Fourth, recognize that no one has earned the right to absolute conviction here, not with inflation still alive, not with oil still disruptive, not with housing still strained, not with leadership transition, questions still in motion. If someone sounds too certain, they are usually selling comfort, not truth. And finally, keep investing. That is still the boring answer, but boring answers survive the longest. You choose the amount, you choose the allocation, you choose an exposure you can live with through real drawdowns. Then you keep buying, whether oil goes higher, whether the Fed waits longer, whether Bitcoin doubles or gets sliced in half first, whether housing drifts or cracks, whether the rally becomes a melt-up or a trap. You keep going because the person who tries to outguess every turn in a market like this eventually gets humbled by the same thing that humbles almost everybody else: speed. The market can reprice faster than your emotions, faster than the headlines, and faster than your desire for certainty. That is why the only approach I truly trust is consistency. Not because I think the next year will be easy, because I think the next year will be exactly the kind of environment where fake confidence gets punished and quiet discipline keeps winning. That is the real lesson here. The Fed may cancel the cuts you hope for. Oil may keep inflation hotter than people want. The market may keep melting higher anyway. And all of that can happen at once. If you understand that, then this stops being an impossible contradiction. It becomes what markets often are in the final stretch of a cycle: rich looking on the surface, fragile underneath, and still very capable of paying the disciplined investor who refuses to panic with the crowd.